Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Tracy Reineck, Zacks Senior Equity Strategist. And we are talking about housing markets and real estate markets in general, which Tracy closely tracks. Tracy, welcome back on the show.
Thanks for having me.
So we had you on this podcast, and I checked, it was in October 2020 to discuss housing. And housing was red hot then. It remained red hot in late 2020 and most of 2021. But once the mortgage rates started rising, investors have started wondering whether there's still upside left for housing. And we know that housing inventory remains at historical lows. Home price growth is at all-time highs. And about the rates, mortgage rates have come down a little bit since this unfortunate war started. So tell us what is going on with housing. Do you see that people are still fleeing cities for the suburbs? Are there still those crazy bidding wars in housing? Tell us about your thoughts on the current state of housing.
Yeah, I can't believe it's been that long since I was last on the podcast talking about this, because it did feel like just yesterday, but a lot has happened in the year in between there. Because if I remember correctly, in 2020, we were talking about whether or not the cities would survive, the death of the cities. And as you said, everybody was fleeing to the suburbs or some kind of, a place with outdoor space. And a lot of city homes are on top of each other or don't even have like a balcony or anything. So nobody wanted any of that. But that has mostly gone away now. It's kind of hard to remember when we were all just simply fleeing, to get that kind of space. Now people are moving, but they're doing for other reasons, mostly because many of us are still working from home. So a lot of the spaces where we've been working from home for the last 2 years now aren't really working for a lot of people. Even if the kids have gone back to school, it's just people want like their dedicated home office. Maybe they thought they would only have to work in the dining room for, 6 months or a year, and now it's dragging on to 2 years. And now a lot of employers are saying, you don't have to come back full time. Some it'll just be hybrid, but that means you're still going to be working from home like permanently. So people just want something different in their lifestyle now. And that's causing a lot of people to move that didn't do it initially on the panic in 2020. So we have all of that going on. And we also have still the demographics of the really large millennial generation that is still reaching marriage age. That is older now. It's 28 to 30 or so. And then once you get married, usually there's some kind of family formation and you want to buy a house or buy just bigger properties somehow. And so we're seeing really strong demand from the millennials across all markets. And then we still have the same demographic issue that we had in 2020 of the baby boomers retiring en masse, and they have been for several years, but we're still seeing 10,000 baby boomers a day retiring. And now, maybe because of the pandemic and how it's kind of created some upheaval about people's choices and what they want to do with their lives, we see a lot more baby boomers deciding, I'm just going to sell my house up in Minnesota where the snow is because I'm tired of that, and I'm going to Florida. So they just want to go. They want something new, and they want to, start a new chapter. And so all of those trends are really fueling still, as you mentioned, an incredibly strong housing market. And we've underbuilt for the last 10 years because of the housing boom and then the bust. The home builders were a little bit shy and scared to build and create inventory when the sales weren't there in the last decade, but now they're there. Home builders are building as much as they can and as quickly as they can, but we're seeing the supply chain issues, labor issues, land issues. People still want to be near major cities where there may or may not be any land or even cheap enough land to be building. And so you have just this perfect storm of the demographics, and the demand is strong. We had the low mortgage rates, which even at 4% are still historically low, and a strong job market, 4% or under on the unemployment. And it is the perfect storm for housing.
Right, sure. Yeah, you're absolutely right. The inventory is very, very low. And, mortgage rates, they have gone up sharply, but they are still very, very low compared to historical standard. People have forgotten how high mortgage rates used to be 10, 20 years back. So
Right.
which areas in the country are still seeing very hot housing markets? Is it still Florida or Idaho, Maine?
Yes to all of those. A lot of people fled to Maine. A lot of people don't realize that is one of the hottest housing markets. But Maine and Vermont, actually, they very welcoming to some new people moving in there, because prior to the pandemic, some of those states were trying to lure millennials to their states because of the aging population. And so now they are starting to see some more movement in there, and they haven't built enough either. So in all the areas you mentioned, especially the Southeast and Florida, Texas, Arizona, places that some of the home builders like to say the sunshine states, where the weather is considered to be good, you don't have to shovel snow. Those areas very hot, but also kind of the trendy major metropolitan cities like Boise, which was more affordable than some of its other West Coast cities. Portland, still hot. Austin remains still hot with, multiple bids and things going on in Austin. Nashville is still hot as well. And so you are still seeing people leaving the Northeast for the most part, except for the area you just mentioned, Maine and Vermont, that area up there. And you're still seeing some people leaving the Midwest area, except for Ohio, which has been luring millennials for several years into like Columbus. Cincinnati has picked up a little bit of steam, but I do think some of these secondary cities, as I like to call them, in the Midwest, especially in the Rust Belt areas, are starting to now see demand not as strong as the Sun Belt area, but still it's picking up in a normal, healthy way, because it's more affordable in those cities. It hasn't seen prices double like in some areas of the Sun Belt. And so people are finding a lot of value in secondary cities like a Cincinnati, a St. Louis, Milwaukee, Grand Rapids, Oklahoma City, those cities that maybe are like one notch down on the preferred list, but your money goes much further.
Very interesting. So let's talk about apartments now. So as you mentioned, when these pandemic lockdowns had started, people had just fled the cities to suburbs and rural areas. And at that time, rents had plunged in most cities, almost all cities across the country. And some people were, predicting death of the cities, but sorry, those were so wrong, so wrong predictions. Rents have started rising sharply. And in fact, in some cities like Boston, Orlando, Miami, rents have even surpassed pre-pandemic levels. In some other cities like San Francisco and Oakland in California, rents are still down compared to their pre-pandemic levels because many tech workers still have remote work. Right. So what do you think about the rental markets as of now?
I think that is very, very tight now too. So when the pandemic hit, they were already building a ton of rental apartments in a lot of the major cities because of millennial demand. And millennials wanted to rent and not buy. And when the pandemic hit, the lenders pretty much put a halt on any new rental towers because no one knew what was going to go on. And if the cities were dead, you're not going to lend money to go build a new rental tower there. So everything kind of just went on pause and then resumed, but it only resumed, in 2021. And so things are over a year delayed of putting new projects into the pipeline. So some of the buildings that were under construction were finished or are on their way to being finished, but it does mean in a lot of cities, there's going to be not as much newer inventory coming on for the apartments either in the next couple of years, but the demand is now there. As you just mentioned, the cities have not died. And even if you can work from home, people still want to live in the cities, even if they're not walking to their office. I know that some people might find that kind of weird, but the cities are still offering things that a lot of people want, restaurants, entertainment, museums, sporting events, that kind of thing. And so they still want to live there, even if not walking, distance or taking the bus or the subway to their offices. So the demand is still strong. Rents are rising in nearly every city. As you mentioned, some are past the pre-pandemic highs. But I do think we're going to see some of the renters try to become buyers, at least in some cities. And while these mortgage rates are still pretty affordable, because it might be cheaper for them to buy something, even with the down payment required, than it is to rent. So that's going to be interesting. But for now, even here in Chicago, we're seeing 95% occupancy again. That was basically the pre-pandemic level. And it might even be higher now. We're waiting to get some 2022 data. And all the apartment deals have gone away. So if you didn't get one, I told a lot of people who were renters in 2020 when they were giving away 3 to 4 months free rent, I was like, try to get that, and they lowered the rents even in some cases. Mm-hmm. And I was like, try to lock in like 2 years if you could, because you knew it was going to go back higher, and it has. And now there's almost none of those deals. Some places in Chicago, you can still get like 1 month's free rent, or they might like give you free parking if they're nice. But all those really good deals have gone away now.
Very interesting. And you're very right that some people like living in the city because there's so many things, so many attractive things about the cities, like restaurants, museums. So if you like those kind of things, you like living in the cities.
Right.
And some companies have started bringing workers back to offices. I just read today that Google has told its employees to return to offices in April. Microsoft started bringing workers to offices this week. And in fact, these technology companies, they were buying a lot of commercial real estate too in the last 2 years because prices had plunged for commercial real estate. So Google, Microsoft, Facebook, or Meta, they spent billions of dollars in buying commercial real estate, everywhere from including in Silicon Valley to Manhattan, Austin, Chicago, Texas, Boston, everywhere. But on the other hand, many companies have announced that workers will have a lot more flexibility. Some newer companies are even 100% remote always. So the outlook for commercial real estate is not very clear, right? Yeah. In fact, I read an article in the Wall Street Journal recently that in 2021, 151 office buildings, hotels, or other commercial properties were converted into apartments. And I also read about this iconic building in Manhattan. It's called One Wall Street. They are converting into apartments, and that would be the biggest office to apartment conversion in New York's history. Wow. So what do you think about commercial real estate for offices and also for malls? Are people going back to malls, or the vacancy rates are still very, very, very high in malls?
Yeah, I've looked at both of those areas as possible investment areas, but all the stocks are really well off their lows, and everybody's kind of already gotten into those trades. So I didn't feel like there was enough value for some of the risk, at least on the commercial side. So I'm not a big fan of diving in on the commercial side. I have looked at the malls because I was actually owning some of those when the pandemic hit. And the death of the mall has been greatly exaggerated as well. The death of the cities and the death of the malls. A lot of the malls that are entertainment based have recovered. And those are ones that have really strong retail partners where the retailers are doing well. And then they put like the experiences in there, whether or not it's like a Top Golf type of thing, a movie theater chain, or, there's various other things that have been going into the malls for entertainment now. So I do like the malls. I like the outlet malls a lot, but those have brought back a lot of the foot traffic, but not so much if the outlet mall is located near a major city where they've seen a lot of international travel. People forget, and I often forgot that, as a traveler, you do like to shop, and you may fly into New York City and then go to a New Jersey outlet mall simply to shop there. But with, travel being impacted by COVID still, that has really kind of taken a hit. So some of the malls are kind of waiting for the international travelers to return, which may happen here in 2022. But again, those stocks have kind of rallied big already. And so I'm not as excited about those. I have also looked at the hotels because I like a lot of the hotel REITs and thought that, I like to travel and maybe I want to own some of those. There's the hotel brands like Hilton or Marriott that you can buy as individual stocks, but then there's also the REITs that can own some of those hotels and then they manage them and all of that under the licensing. And so a lot of those stocks, even in 2020, had a recovery, and then, it's been a little iffy since then, but most believe that most of the hotels have rebounded as well. And those that got into trouble during the pandemic because they had to be shut down and the, business travel is not returned if they're in major urban cities, those they're selling or, there's otherwise I don't want to own those. But the resorts, those are booming, but it's already too late, I feel, to buy some of those. Those stocks have run quite a bit and I feel like are somewhat expensive for the outlook, which is good, but not as good as what everybody is hoping. And like most of the upside is already priced in to those areas. But I would be interested in looking at commercial. I haven't looked at it for a while, but if you start to see, more of a return, I do think over the next couple of months, we're going to see what happens in the major urban centers. I know everybody is hoping that, there's some return so that you get some life in there. But even in Chicago, in the Loop, for example, it has used residential conversions to bring life in there over the last 20 years. Numerous of the old commercial buildings have been renovated into lofts or apartments and condos in Chicago's Loop. And those have been successful. So I think that's a good way to go. We do need more housing, and some can be apartments, some could be condos, and that's a way to bring a lot of new properties on board. But I think we're going to have to wait and see how many people actually return and how much of the excess inventory that's out there on the commercial side gets absorbed, in the next year or so. Because I think there's been a lot of surprises with the pandemic on real estate, because even just thinking about, the death of the city, we kind of laugh about it now, but that was a serious thing for at least 6 months or maybe more, maybe like 9 months. It was a little bit, you didn't know for sure if it would come back. And now we know that it will. But so all the predictions about, commercial real estate will likely probably be wrong too. In
Right.
some way, you're going to be wrong. But I await to kind of see, and that probably means, it's too late because I'm waiting. Because then we'll know, and then everyone will dive in. But that's okay, because there are other ways you can invest
Sure.
in various
Yeah.
real estate.
So let's talk about the investment angle a little bit more.
Yeah.
So there are two major housing-related ETFs. There's one by iShares, which is the iShares US Home Construction ETF. Ticker symbol is ITB, and there's one by State Street. It is the Spider S&P Home Builder ETF. Ticker symbol is XHB. These two ETFs are quite different from each other. ITB is market cap weighted, and it is very top heavy, with 4 builders accounting for almost half of its portfolio. Those are the 4 major big builders. XHB is equal weighted, and it has a lot of exposure to home furnishing, home improvement companies as well, like Whirlpool, Home Depot, Masco, etc. So both these ETFs are down significantly this year. These both are very hot in 2020 and most of 2021 as well. But once the mortgage rates started rising, these ETFs have not done very well. XHB was doing slightly better, but then post-earnings meltdown at Home Depot affected that ETF as well. So do you think investors could look at some home builders, which you think that outlook is still good, or because they are too cheap?
Yes. In an easy answer. I like both of these ETFs here, especially on any of this weakness. Even though normally I wouldn't be super enthused to buy the one with the home improvement companies still in there, the Home Depots and of the world and all that, if I only wanted the real estate side. But both areas had really sold off here because they are kind of tied together. We saw really hot furniture sales in 2020 and 2021 because we were all, staying at home and nesting and vacationing at home. So we bought outdoor furniture and grills and desks to work from and all that stuff. And everyone assumed that was going to end, like that strong demand could not continue on. But when you buy a new house, either a new construction or existing, when you move in, all of us know you buy new things. You're like, ew, my couch is old and nasty. I want a new one. So with the home sales still strong, all of these companies are still basically crushing it. I keep listening in on their conference calls to see, maybe they're going to talk about a slowdown now here into 2022. The street all thought that 2021 would be peak earnings, but they kind of thought 2020 would be too. But they really thought 2021 would be, because it was records for a lot of these like home type of companies. And then it's not, even Home Depot is not saying doom and glooming things about 2022. They're just not. And so I like both of these. If I really wanted just the builders, the one that's, 50% is those 4 builders, then that's the way to go, because the home builders have sold off on the threat of rising mortgage rates, because historically they have seen slower sales when the mortgage rates have risen. So in 2018, the mortgage rates rose from around 3.6 in 2016. They hit a low of 3.6%. They rose almost up to 5% by 2018. It's kind of hard to recall them being that high not too long ago, but they were, that's significant. And so sales did slow, and the home builder stocks were all down about 30% off their highs, because it does impact their earnings. If the sales slow, some of their gross margins might get hit. They can't raise prices as easily because demand is down, all of that. But this go around, I hate to say it could be different this time, because normally I hate that because it never is. But this time we are at record low inventories, as you mentioned, Nina, early in the podcast. We have record low national inventory in existing homes, and even in the new builds, there's wait lists for almost every community. And so the home builders still have tremendous pricing power. And even if some of their possible customers who are on the wait list, for instance, even if mortgage rates rise significant enough where they decide, hey, I'm not going to buy that new house now because it's a little too pricey for me, so I'm going to get off the wait list. There should still be, for at least for now, enough other buyers with, good FICO scores, the down payment, who can afford that house. And, there should still be a wait list there, or at least that's what the home builders believe is going to happen. So I've listened to a lot of their conference calls from this last quarter where they're giving their guidance for 2022. They also talk about the robust demand that they're seeing out there, and they don't see any slowdown. Toll Brothers, for instance, ticker TOL is that one. They're the luxury builders. So, luxury is holding up. Luxury in everything, cars and just everything is doing really well right now. But they have said on their website and in their showrooms, their sales centers, they have not seen any decline in traffic in either mode, either online or in person. And that is where they normally see the first signs of a slowdown. Because obviously, hey, it's too pricey. We're not going to the sales center, right? Or you don't go on their website and dream of buying their house on there if you're not going to do it. So they're not seeing it. They're not seeing any of the slowdown, not yet. Now, it could happen once the rates get up over 4, but I think it's going to have to be a lot higher to see a more significant slowdown. So these sell-off that we're seeing here in 2022 in a lot of the home builders, and even in these ETFs as a result, is a little overdone, I think. It's kind of saying this whole cycle is done and these rising rates are going to end it all. But yet we've got all, millions more millennials, and the Gen Zs is also a big generation. They're coming up next, and we haven't built enough, and we're at record low inventory. So that's why I feel it's a little different this time, and that we will see a slowing when those rates rise. We just will, especially among first-time buyers. But I don't think it's enough to end the good times for the builders. And part of that good times is, pricing power. They have the pricing power still. I listen for that on all their conference calls. Are they can they still pass through the inflationary pressures they're feeling, because all of their input costs are still rising. And lumber came down big, but then it rose again. Labor still big inputs for them. And then there's these weird shortages because of supply chain on various things like garage doors, even appliances, depending. Just various framing was an issue for a while. They couldn't get that. So, but they're able to pass through any kind of, increases on prices that they're paying to get these items through to the customers. So, and customers are paying it. So I like both of these ETFs here, and I like them more if there's even further weakness. And I do like the home builders.
So in addition to these two ETFs, ITB and XHB, there's another way to play housing and real estate markets, that is through REITs. Now, REITs, they own and operate income-producing real estate properties, and these are also seen as an inflation hedge. So that is another, good outlook about REITs. Now, most REIT ETFs, the broader REIT ETFs like VNQ, which is the most popular REIT ETF by Vanguard, they have a lot of exposure to commercial real estate, including office buildings and shopping malls. And as we discussed, the outlook for office buildings and shopping malls is not very clear as of now. We'll have to wait for some more time. So there are 2-3 ETFs which have more exposure to residential real estate. So maybe we can take a look at them. Yeah. This one by Nuveen. It's called Nuveen Short-Term REIT ETF. Ticker symbol is NURE. So this has a little over 50% exposure to apartment REITs, and about 23% exposure to self-storage REITs. And self-storage REITs have also been very hot lately because when you are working from home, you want more space in your house. So maybe you are storing your, random things away in a self-storage. Right. So, and these are shorter-term leases. So when inflation rises, these REITs are able to, increase their prices also. So they have a less sensitivity to rising interest rates. So they do better during rising rates environment because they have the pricing power. There's another REIT ETF, which I like, which again has a lot of exposure to housing, residential real estate. It is by iShares. It is the iShares Residential and Multi-Sector Real Estate ETF. Ticker symbol is REZ, and this has this also has about 50% exposure to residential REITs and about 27% exposure to healthcare REITs. And there's one more REIT ETF which is brand new. It launched just this week. This is by a new provider, and the ticker symbol is HAUS. It is the Home Appreciation US REIT ETF. And this is the first actively managed pure play residential real estate ETF. So it holds only apartment REITs. So with a lot of pricing power, this REIT ETF should do well in a rising rate and rising inflation environment. But since this is a new ETF and it is by a new provider, I'd recommend some caution. Maybe wait for a bit till it gathers some assets, maybe about 25 million or something like that, or take a small position if you believe that apartment REITs are going to continue to do well. Do you like any other areas related to housing or home building or REITs which you think will continue to do well going forward?
Well, I do like the furniture manufacturers and retailers. So I track a whole bunch of them, and all of those have really, taken a step back because everybody thought that the furniture was done, but it's not. Some of them haven't reported earnings yet. So we're still kind of waiting on the fourth quarter to get an outlook for 2022. But a lot of these pay good dividends on the furniture side. So that's also why I like them. One of my favorites, which I do own in my own personal portfolio, is Williams & Sonoma, ticker WSM. And that's down 18% over the last 6 months. And it pays a dividend yielding 1.9% right here. But the shares are still pretty cheap, trading at 10 times. And the reason I like Williams & Sonoma and why I bought them pre-pandemic even for myself, was because they own West Elm. And everyone buys West Elm. I don't know about you, but I own some West Elm things. I think everybody does. And West Elm has been one of the premier furniture brands for, I would say, the last decade even. It's basically the furniture brand for the millennials, and they love it. And the demand has never gone down. And during the pandemic, obviously, they were buying more than ever. But Williams & Sonoma also owns Williams & Sonoma, which was they have this like the small appliances, the bread makers, the coffee machines, all that went crazy during the pandemic, and that's kind of normalized. But a lot of more people are cooking from home now. That is one of the results of the pandemic. Like we all had to cook, and now we figured out, hey, I don't mind this. It's kind of fun to make some stuff. And so more of the cooking items are selling than were pre-pandemic. So that's a nice result of the pandemic for Williams & Sonoma. But they also own Pottery Barn, a lot of people don't realize, and Rejuvenation, the lighting, and they have some furniture at Rejuvenation. And then they're launching, they have launched an upscale furniture line that's called Williams & Sonoma as well. But that's a very small brand right now, but I could see a bigger future for that at Williams & Sonoma. So, but like I said, I like a lot of the furniture companies because I don't think that nesting thing is going to go away, because we're either going to be renting the apartment and we want some nice furniture, or we're buying something and we want the nice furniture. And all these home furnishing companies sell outdoor furniture now, and that's huge. We are, even on the reopening, we have discovered our backyards or our balconies, and we want it to be fun and nice out there too. So the outlook is still good. And all these furniture retailers, the ones who have reported, are not seeing a slowdown. And so they still have big backlogs because of the supply chain issues. And it does depend on where they manufacture. So you might want to listen in on some of the conference calls. So Williams and Sonoma, big out over in Vietnam. And so during COVID outbreaks, especially the Delta outbreak in 2021, their supply chain really slowed down. So I know some people waiting like 8 or 9 months for a couch now from Williams and Sonoma. But other ones, Ethan Allen, for instance, they manufacture in North America. They have all their manufacturing in the U.S., Mexico, and Honduras, I believe. But doesn't mean they're still not going to have supply chain issues, but it's just a little bit different location. So that's something to keep in mind with a lot of these various manufacturers, like where are they manufacturing? Can they get it to the customer? And what's going to be the cost of getting it to the customer right now too. But the furniture companies and retailers have all been raising prices as well and passing along, and it's being absorbed by the consumers so far, at least. So that would also be in the ETF with the, home improvement and furnishings ETF. You'll find a lot of these furniture retailers.
Both very interesting picks. So Ethan Allen, I see that it's a Zacks rank number 1 strong buy stock too.
Yeah.
And the ticker symbol is ETD. So go check that out. And Williams Sonoma.
Yeah. And just on Ethan Allen, they pay a very nice dividend. They are very shareholder friendly. They've been giving back cash during the entire pandemic. And they have, I believe, no debt either. So they're just like here, and they paid a special dividend in 2021, I believe, too. So if you go and you look and see what it is, you might be like, that's not that good, Tracy, looking at it, if I recall. But I think it still is good, even their base one. But they did pay a special because they just have too much cash. Yeah, it's like 4.5% for their base. Wow. So some of these, you can get some good dividends with some of these like home type of stocks right now.
So a lot of options to play this hot housing and residential real estate market. As Tracy mentioned, the 2 ETFs, ITB and XHB. Take a look at these furniture retailers, ETD and home furnishing. Williams Sonoma, ticker WSM. And the residential REIT ETFs that we discussed, NURE, and the one by iShares is REZ. Tracy, this was a really interesting discussion, and I'm sure we'll discuss it again in a few months because there's a lot happening in these markets, and particularly we'll have to see how the commercial real estate markets react to, these return to offices, and how many companies announce return to offices after Google and Microsoft.
Yeah, and we shouldn't wait another year or so. We should get together sooner because there is a lot going on, and yes. I will be intrigued to see, what's happening in with commercial by this summer. I think it'll be real interesting to see. So.
Thanks for listening. Make sure to check out Tracy's podcast. She hosts 2 podcasts every week. It is Zacks Market Edge and Value Investor Podcast. If you like our show, please leave us a rating on iTunes or wherever you get your podcast, and also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.